Hello, everyone. Thank you so much for joining us tonight for the PSPS Lit webinar series. This is the first episode of a three-part series, Financial Foundations for Fellows and Early Career Physicians. And we're going to give people a moment to log on, and we'll be right back with you. Thanks again.
All right. Hi, everyone. I'm Rajot Bandal. We'll kind of start things off here, not take up too much of your guys' time. Thank you for being here with us this evening. So essentially the idea behind this webinar series, we're gonna have two of these. This is the first one. It was a little bit kind of, something that I wish that I had when I finished training 5 years ago. So I was initially in private practice and then I joined a hospital-based practice, but coming out of fellowship, as we all know, we don't really get a lot of the financial education that we all wish that we had. And this was basically something that we kind of had to go looking in a bunch of different areas to try and get this information. So I kind of wanted to have this series. So all of the questions that I had to go to multiple different websites and people and ask them for, hopefully we can have a lot of those answered today. And we have a really good faculty on, kind of all stars of financial advice, and I'll kind of just let them introduce themselves as we get to it. And then this one will be recorded. So I know it's going to be very densely packed, a lot of good information, but you should be able to access the recording and kind of look through it if you need to later on. And then towards the end, we'll also talk about the upcoming episode 2 and then episode 3. But basically, episode 2 will be on the 20th of November, and then episode 3 will wrap up on the 11th of December. We'll give you information about that towards the end. But without further ado, we'll kind of get started, and I'll have Dr. Dave Russo start things off.
Great. Thank you, Harjo. So as Harjo mentioned, my name is David Russo. I'm an interventional pain physician and physiatrist. I practice up in Portland, Oregon. Our group is a single specialty pain group. We have 5 interventionalists, 6 PAs, and integrated behavioral health. And again, I think this is such a great topic to be getting exposed to early in your training. Most of the lessons I learned about money matters, I learned the hard way. So I'm really happy to be able to impart some useful information to you. I want to step back a little bit and just talk about the big picture. Recognize that in the United States, the healthcare industry is a $4.8 trillion enterprise. So let's just say it's $5 trillion. And when you look at who pays for healthcare, most of that, at least half of that, comes from the public sector. So that comes from tax revenue. About 30% is through commercial or private healthcare insurance, and the remainder is direct consumer or workers' comp or PI type medical legal work. So the reason why it's important to understand who pays for healthcare is to understand that when you're looking at joining a group or joining a practice, one piece of information you want to know about is what is their payer mix? Do they skew more towards the average? Do they skew more towards having more commercial and private insurance? Are they a group that does more PI and workers' comp? Because that's going to certainly affect the kind of frame of negotiation you have and probably the kind of compensation offer you're going to receive. In healthcare, doctors are paid through a variety of different compensation models. So there is everything we do is attached to a CPT code that's assigned a relative value unit. that relates to a specific kind of diagnosis that translates into a payment. And these contracts vary tremendously between payers and payer sources. So again, understanding what kind of procedures you're going to do in what kind of facility or site of service you're going to do them also impacts how you're going to get paid. So next slide. So generally, when we sort of break it down like this, I think of at least kind of three different physician employment models. There's the wage-based or sort of employed physician model. This is where you are paid the bulk of your compensation through what's called an IRS W-2 form. This usually translates into some kind of fixed salary and a bonus. The advantage of this is that it's very stable, usually comes with benefits, but comes with the liability of high taxes. So early in your career, having a W-2 type arrangement probably makes a lot of sense. It may make a lot of sense for other reasons at other times in your career, but recognize that being paid or compensated through a W-2 kind of mechanism is a very tax inefficient way for a physician or any high earner to generate their income. Then there's the 1099 contractor model. So usually after a period of time, you might want to branch out a little bit, have some side gigs, do some consulting. Well, now you're both kind of, your own employee and your own boss. So you're compensated as a 1099 contractor because you're controlling your work conditions. And that brings even more autonomy. You're also responsible for more additional taxes. And then finally, if you find kind of the right kind of practice you want to open or buy into, you can develop an equity stake in the enterprise and you become an owner partner. And in this model, you're compensated both through wages and a percent of profits. And that comes through a K-1 type tax form. And we'll talk about how that kind of arrangement can give you some flexibility in tax efficiency. So next slide. So again, knowing kind of what model you are in is important. Understanding the bonus structure of the compensation model you're being offered. Is it based on a percent of collections, i.e. a eat what you kill type arrangement, or is it based on certain RVU or production incentives? Or are you actually being sort of treated like an equity owner in the sense that you're being exposed to both the upside and the downside of the practice, i.e. you're generating revenue, but your revenue is being offset by your own direct expenses. So understanding all of those details in your compensation arrangement makes a huge difference in understanding what the number is at the top of your paycheck and what the number is that you actually bring home through the door. So next slide. So basically, I think of things like this. I kind of think, early in your career, probably an employed W-2 kind of arrangement makes a lot of sense. It's very focused. It's very stable. It's a good time for you to develop your personal and household budget. Then you probably branch out and develop some consulting arrangements. You're kind of an independent contractor. If you're interested in buying into a practice, you may be on a partnership track, and that usually involves some kind of process around valuation and buy-in. And then finally, you have equity in the practice, and you're actually being paid both through wages and a percent of the profits that the company or the practice generates. Next slide. And in our group, that's exactly what it looks like. So when we onboard physicians into our group, I tell them, you're going to come in and we're going to pay you a salary. This is me and my partner just opening up our wallets and paying you every month because, we've got a lot of sunk costs into credentialing and insurance panels and all of these things. So that's kind of the subsidization phase. And then eventually you kind of become productive and now you're kind of generating, your own revenue, and it probably makes sense to sort of put you on a model where you're getting paid a percentage of your revenue. And then if things are going well, you probably want to learn more about the business. And so we kind of look at exposing you to some aspects of kind of the upsides and downsides of the business. And then finally, there's the process for buying in and actually becoming a partner. So next slide. So what do you get when you buy into a practice? What are you buying? Well, you're buying into a legal fiction. You're buying into a corporation that exists to do business. And if the business is run well, it generates a profit. And as an owner, those profits get passed through to you, uh, to your compensation. So you become a shareholder and you become entitled to a percent of the profits. This allows you, through the advice of various tax attorneys and CPAs, to sort of divvy up how your income gets distributed, either as a W-2 employee. Some of it can come to you through W-2 pathway, some of it can come through the K-1 pathway. Next slide. The hardest part of deciding whether or not to buy into a practice is deciding how much the practice is worth. That usually is based on some kind of third-party evaluation. And then, from there, the other points that you kind of want to negotiate around are things like your account receivables, i.e. how much money you have kind of in the cash register that hasn't been allocated to you, and then anteing up into a reserve fund. So any well-run practice will have a reserve fund. There's usually a process where a new associate who becomes a partner needs to ante up into that reserve before you can actually start taking money out of the business as profit. Next slide. So this is just a hypothetical example. This is my final slide. So this is just a hypothetical example of how a $400,000 compensation offer can look very different under very different circumstances. So if you're a W-2 employee, you may have $400,000 before taxes, but after taxes, you're probably bringing home, maybe half of that. If you are an independent contractor and you have business-related expenses, maybe you're bringing home a little more than half of that. If you are an owner and you have other ways of offsetting your income through business-related expenses that relate to the practice, then this is by far the most tax-efficient way to earn that money and keep more in your pocket and pay less in taxes. So my closing thought tonight is recognize that as physicians, we're kind of socialized to be rule followers, but we don't just work in healthcare, we make healthcare happen. And you participate in the capital structure of how the healthcare enterprise works. So take the time, as you've done tonight, to develop a good understanding of how the money flows and design a career that is both rewarding to your skill and puts you in a place and in a practice that you want to be. Next slide. I'm not going to be available for questions at the end of this, unfortunately, but this is my contact information. The name of my practice is Columbia Pain Management. This is my personal cell contact. I've been mentoring medical students, residents, and young physicians for almost 2 decades. So please feel free to reach out if you have any questions or want to talk about any other career or compensation related topics. I'm happy to be a resource for you. And thank you, PSPS, for facilitating the development of this curriculum, which I think is often overlooked and essential in the education of young physicians early in their careers. Thank you.
Okay, thanks, Dr. Russo, my Portlandian neighbor. My name is Justin Harvey. I'm not a physician, but I'm married to one. My wife is in private practice in anesthesia at OAG here in Portland, Oregon. I am a financial advisor, wealth manager, work with many pain doctors, particularly those in independent practice who are practice owners and surgery center owners in many cases. I love an opportunity to educate physicians. So I'm excited to be here tonight, excited to pack as much value as possible into the next 24 minutes that I am allocated. Next slide, please. So I run a firm called APM Wealth. I also have this podcast, Anesthesia and Pain Management Success. If you want some more enrichment material, there's 200 some episodes there you could check out. Next slide. To keep the lawyers happy. Next slide. Okay, I spent a lot of time on this meme, so let's take a minute and enjoy it, soak it in. Perhaps there's some pain physicians out there who are bound for private practice and envious of their physician friends who can work for a nonprofit or governmentally related entity. Next slide. So with regards to student loans, it's expensive to go to med school. It's expensive to allow debt to continue to accrue interest during residency. And so physicians who are leaving training and entering attendinghood are faced with this fundamental question: should I go for a repayment track, which means just pay back every penny that I owe, or should I go for a forgiveness opportunity, which in this context we're going to limit to PSLF, Public Service Loan Forgiveness. One or the other, and getting on one track and going towards that destination as soon as you know is typically the most economically efficient path. There has been a lot of noise in the news and with this administration and with the Department of Ed and with right now the government being shut down. And I'll be honest, I don't even really know what that means with student loan processing. But I will say that this fundamental question, the repayment versus PSLF question, has not really changed much as a result of all the noise we've heard in recent months. I actually have had 3 clients of our firm in the last 12 months or so achieve PSLF. So it's still happening. People are still getting forgiven, having that debt drop off tax-free. So anybody who's on that track, I would strongly encourage you, like, if everything looks good, if you've got the right type of loans, you're moving in the right direction, stay the course because it is happening. Don't get scared and pull the ripcord just because of the noise. Next slide. So let's talk about PSLF first. So this is a tax-free, as of the time of this webinar recording, tax-free forgiveness of any direct federal student loan. Has a number of requirements. You've got to pay for 10 years, and this would include your residency as long as you're with a qualifying employer during your residency. So that's 120 monthly payments. You need to be on a qualifying income-driven plan, which they are all listed here, as well as the SAVE plan, rest in peace, and the RAP plan, RAP. That's the new plan introduced by Republicans that's going to go live next year in 2026. You've got to work for a qualifying employer, which means any 501c3 or any governmentally or municipally oriented entity. And then you've got to certify your income annually, certify your employment annually, rinse and repeat until you cross the event horizon of 120 payments. It's a really good idea to monitor this ongoing, keep track of everything. Every time you talk to somebody at one of your student loan servicers, take fastidious notes, get their employee number. Basically, assume you're going to have to prove everything later in court. And I have had cases where there are appeals necessary, where you need to sort of escalate problems in loan servicing that could be costly, and you need to talk to a manager, go to the ombudsman. There is recourse in the student loan infrastructure for people who have challenges in their student loan processing, but document everything. You'll be glad that you did. Next slide, please. If you're going to go for full repayment, this is the opposite of PSLF. PSLF, you want to pay the least you possibly can for as long as is required to maximize that forgiveness benefit. For full repayment, you want to do the opposite. You basically want to shovel money onto the loans as quickly as possible to get them gone. Sometimes, in some cases, refinancing can make sense in order to reduce your interest rate. I was looking at this today with a client and I saw rates in the mid 4s for a refinance. Most people who have federal loans are in the 6+ range. So if you're going for full repayment and you have loans in the 6+ range and you're sure about full repayment, then refinancing can result in a meaningful rate reduction that could save you thousands over the life of your repayment. Now, this is the most important thing. And if you take only one thing from this section about student loan repayment, please take note of this. Once you refinance, you permanently leave behind a number of meaningful benefits that are inherent in the federal loan system. Any income-driven option is no longer accessible to you, meaning getting on pay-as-you-earn or revised pay-as-you-earn or IBR. Those are great because if you lose your job or if you get hurt or if you get married and your household economics changes, though there's a built-in adjustment to your amount of income that will allow your payment to float to an affordable, and I'll put it in air quotes, affordable level. You can't get that if you refinance with SoFi or Credible or Earnest or one of those guys. You can't go into forbearance. So with a federal loan, you can basically just tell the servicer, hey, I don't want to pay for a while. And there is some nuance to that, but really, you can just claim economic hardship and have forbearance for 12 to 36 months in some cases. You can't get forbearance if you refinance. Number three, disability discharge. If you get hurt and you have a long-term disability claim and you meet the Social Security threshold of disability, which is basically an attending physician certifies that you will not be able to be gainfully employed for 60 months, 60 months because of your injury. If that happens, all of your student loans go away. I actually had a client who had a disability discharge because of a chronic illness that prevented them from working. And they had a six-figure amount just evaporate tax-free. That doesn't happen once you refinance. And then finally, any forgiveness. Forgiveness is no longer in play once you refinance. So you got to just plow your way through it. And then if you do have something happen, if you do lose your job, if you do get hurt and you've refinanced, there's no recourse for you. You just got to earn your way through it, pay it off. And that is what it is. So refinancing and full repayment can be a great path, but you've got to make sure that you're ready to leave these benefits behind before you go this route. Next slide, please. So here's an example of current rates. I just pulled this the other day. This is taken from, there's a company out there called Student Loan Planner with whom I have no affiliation. I did consult with them a few years ago, but I don't have anything to do with them now other than they're a great resource. They create a lot of education and they also have the best refinancing bonuses that I'm aware of on the interwebs. So if you go to studentloanplanner.com/refi, you can see all their deals here and they have these cashback opportunities if you refinance, and they also post the available rates there. Variable versus fixed is a question you're going to want to consider. It sort of depends on your appetite for risk and how long you plan to take to repay your loans. If you're on a variable rate and you're planning to take 20 years, you're leaving yourself open to some interest rate exposure, whereas on the fixed, you'll be a little more protected. Next slide, please. Okay, so this was a criminally abbreviated flyby of student loans. And in the interest of time, I'm not going to get into these items, but I will say, just be aware, taxable forgiveness over 20 years, that's a thing. In some cases, it does apply. Disability discharge you want to consider, and marriage is important. Like who you marry, what their indebtedness is, what their income is, that makes a big difference in your loan repayment. So consider talking to a student loan expert before taking that step because it may have big implications for your repayment and forgiveness opportunities. Next slide. Okay, this is the next section. Now let's talk about Personal Finance 101. This is designed for folks who are just transitioning to attendinghood. The time of maximum cash flow pain is often in those first 12 months after you finish fellowship. You might be getting married, you're moving, you're maybe trying to buy a house, everything is converging and there's a lot of pressure. So it's helpful to know that when you're in the midst of it, your student loan payments are coming back online and ratcheting up and everything is hitting, just know that this is probably the worst it's ever going to be. It's helpful at this time to specifically establish a savings rate, meaning what percentage of my income do I want to save for my future self? Set that up in advance at the beginning, and then it will be way less painful than doing it later on after you've already established a lifestyle, your fixed expenses are what they are, and there's a lot less flexibility in your financial ecosystem. Next slide. So here is the order of operations that I suggest for anyone who's either recently transitioned to attendinghood or is looking at doing so. First, sit down and think about your goals and what you want. If you're married, talk to your spouse and form these with them. If you're working with a professional advisor, you're going to want to do this with them. Figure out what your emergency fund amount should be, meaning how much money do I need in the bank, accessible to me, to not be stressed about money, so that if my car has engine trouble or my roof leaks or some other random thing happens, I'm not going to be anxious at that event occurring. Then we want to set a desired savings rate, probably somewhere between 10 and 30%, depending on your goals and depending on if you're a high cost of living area and depending on if you're trying to save up to buy into Dr. Russo's practice, or if you want to live in a really nice house that you need to save for, or if some other, based on your personal goals, you want to think about a savings rate in the context of those goals. Then you want to automate as much as you can to achieve that savings rate without additional emotional energy required. If you've got to log into your checking account every month and then push money into that investment account, it's a lot of emotional energy. If you automate $8,000 a month from checking into that taxable investment account, then you're doing 100 grand automatically by default. And so that's a nice place to be. And then I'll talk a little bit about budgeting, and I put it in air quotes here for a reason. Next slide, please. Okay, so here are some examples of goals. I'm not going to read all of these at you, but you can get an idea. Some of them are concrete and financial. Others are perhaps a little bit more abstract and qualitative and still important and still worth acknowledging. Like, for example, raise kids who appreciate the value of money is the last one on this list, and it hits home with me. And anybody who's a physician on this call, your kid is going to grow up in economic abundance, and having them appreciate the value of money is going to be an uphill battle that you're going to need to get involved in that battle early on if you're going to win it. Next slide, please. Okay, so emergency fund. Typically, this is described as 3 to 6 months of living expenses. In order to do that, you need to know what your living expenses are. So how much does it cost you to survive and pay all of your debt obligations and all of your bills for 1 month, then multiply that by 3 to 6. And then any near-term needs, we would also add into this emergency fund amount. So I need to buy a car, I got a wedding coming up, I have a big business commitment coming up. We would want to make sure that that's also allocated in this account. So in this example, maybe it's $150,000 in total for 3 months of living expenses at $17,000 a month, plus a down payment for a pending home purchase. So 150K is the amount that you would want to carry in that emergency fund. That would be in a high yield savings account earning 3.8% interest, so that you're not just watching it gather dust in your Wells Fargo checking account. Next slide. Savings rate, I like to call this a little more constructively a wealth building rate, meaning what percentage of your gross income is going towards moving your net worth northward. So we would count any debt pay down contributions, student loan payments, the principal part of your mortgage, paying off consumer debt or car loans, any of that would count because it's moving your net worth in the right direction. I would strongly recommend, if you're in a situation you can't save at least 10%, you probably should question some of the assumptions about like who you're working for or where you're living, because you're just only ever going to be economically stressed if you can never get your financial house in enough order to move your savings rate into the teens. 20% is a good target if you aren't really sure and you're wondering what the number is. 30+% is typically what I see for clients of mine who are like, I want to be financially independent as soon as possible. I maximally value autonomy and decision-making power, and I'm willing to trade off some of the present day comforts in order to get free sooner rather than later. Next slide. So here's an example of how a savings rate might work. On a hypothetical physician income who's making $500,000, they're probably going to max out their 401k, which is $23,500 for the employee contribution. They're also going to do their backdoor Roth IRA contribution because they're smart. That's $7,000 for a person who's under age 50. They're going to pay $3,000 a month on their student loans for another 36 grand. And they're also going to do $5,000 per month into a taxable investment account to be building wealth in that vehicle as well. This is a pretty typical arrangement for somebody who's in the first couple of years of attending Hood and has sort of beefed up their cash to the point where they're ready to start allocating money to other wealth building pursuits. This is 126 grand. Put that over the denominator of the income, and the savings rate here is 25%. So this is pretty robust, as you can see. Next slide. Okay, budgeting. This is all I'm going to give you, which is if you do it right, you don't need to do a budget. You would have a system where you have an amount of cash that you start with at the beginning of each month. So in this case, we've got Akash and Regina, our married couple, dual physician household. We've got a high yield savings account and a joint checking account in the middle. The sum of those is $100,000, split kind of optimally. They want as much as they can in the high yield savings to earn interest, and as much as they need to not bounce checks in the checking account. And so at the beginning of the month, Akash gets paid, Regina gets paid, that 30K goes up to 61K. Their credit cards get paid, their bills get paid, all the money sort of sifts back out at the end of the month. They look and they got 39 grand. So they did zero math, they did zero budgeting, and they know they were plus $9,000 for the month. So at the end of the month, they take that 9 grand, they move it through the system here, and they drop it in a taxable investment account. Now it's the beginning of the next month. They start with 30 grand. Akash gets paid, Regina gets paid, money flies all over the place. You can probably see where this is going. At the end of the month, they look again and it's $41,000. Without doing any budgeting, they know they were plus $11,000 for the second month. So they take that 11 grand, they push it through to a taxable investment account that's in accordance with their long-term savings goals. Now it's the beginning of the third month and they're at 30 grand again. No budgeting required. So they're starting to build a data set here. Plus 9,000, month number 1, plus 11,000, month number 2. Eventually, they'll get to a place where they've built enough of a sample size where they can say, okay, let's go ahead and automate a savings of $5, $7, $10,000 intra-month, so that now they're kind of just treading water. Their cash is always right around 30 grand, and the wealth building is automated. If you do that and everything works out and you're living within your means, there's no budgeting required. Because nothing pains me more than having to try to manage a physician's latte budget. I just don't believe that that should ever happen. Next slide, please. Okay, great. Next section. So retirement planning. I like to call this planning for financial independence instead of retirement, because retirement sounds boring and being free to do what you want is much more interesting and fulfilling. There's a lot of things in retirement planning and in long-term financial planning, a lot of things that are outside of your control. You can't control what the economy is going to do. You can't control the impact of tariffs on the stock market. You can't control, you really can't even control the performance of your investments over time in a short term. But there are a number of things you can control. So positioning yourself for success is all about identifying the things on that list that you can control and then optimizing them. So they're listed here. Account types, expense ratios. You want to keep expenses as low as you possibly can, making sure diversification is on point, meaning broadly diversified across industry sectors, across geographies, different countries, and you have the right stock to bond mix. You want to think about time horizon, investment vehicles, all the rest of these things. We'll get into in more detail. Next slide. Okay, yeah, these are the things you can't do anything about. Interest rates. Trump says rates are going to be lower. He's trying to get out the brass knuckles and beat on the Fed to make that happen. Who knows if it's going to work? If it does work, who knows the impact that's going to have on your portfolio? It doesn't matter. It shouldn't matter. If your savings rate is high enough, if your investments are low cost, if you're fully diversified, and if you're plowing money into those investments over decades, it will not matter. It will be utterly irrelevant. There's nothing more satisfying for an investor than to know that all these things outside of my control, I can render them irrelevant by taking control of the things that I can control and optimizing them. Next slide. So I want to talk about account types and how you control those and optimize for those, and do so in a tax optimized way. There's no bigger expense that a physician is going to have. Basically, once you're an attending, basically for the rest of your life, with the exception of like interesting business deals or maybe some real estate stuff, but for the rest of your life, basically every year, your biggest expense is going to be taxes. And so minimizing the bite that taxes take out of your wealth should become mission number one in the realm of wanting to advance your wealth efficiently. Next slide. So if we extend our example with Akash and Regina, here's how this might look for this couple who dual income, they both have a retirement plan, they can both max that out. Maybe they have access to an HSA in 2025, that's $8,450 that they can put into this account. That's pre-tax, reduces your income tax in the current year. Maybe they also have a dependent care FSA, they've got a couple kids, some of them are in a daycare, and they can do another $5,000 there. So everything in this tax priority number one section, these first four accounts, the 401k, 403b, HSA, DCFSA, these are all going to reduce the taxable income of this household. So if they're each making $500,000, that's $1 million total. We're going to take this, 46 plus 13, $59,000 off the top. So they're, instead of being taxed on $1 million, they're now taxed on 941 grand. So still a lot of taxes, especially if you're in Multnomah County, Oregon, or in the Bay Area. But it's a movement in the right direction. So you want to make sure that in the context of this hierarchy, you're taking advantage of this first tier of reducing your taxable income in the current year, max out all of those. Then, oh, and quick aside, on the HSA, the point of maxing out the HSA is not to use it to pay your healthcare expenses. It's actually to invest it. Most HSAs, once you achieve a certain minimum, they will allow you to invest. So you can actually put it in an index fund or a target date fund or something and do that $8,000 every year. It's kind of like a bolt on to your 401k. So it grows, you get a deduction in the current year, it grows income tax free. And then if you take it out in retirement using certain strategies for attributing withdrawals to historically realized healthcare expenses, you will actually never pay taxes on that money. The HSA is the most tax advantaged account out there. It's kind of a little known secret. So that's tax tier number one. You want to max out number one, but then you can see here, you're going to get to $59,000 of savings. And as we saw in our example, that household, even just a single earner making $500,000, if they want to save 25%, they've got another 70 grand to go. Where's that 70 grand going to go? So now we're in the second tier of tax optimization and account types, where we're looking at Roth IRAs, which are tax-free individual retirement accounts. So you put money into that Roth IRA, it's never taxed again, it grows tax-free, you give it to your kids, and they can have it tax-free in the future. Note, once you're making over a certain amount of money, typically, I think for a married couple, it's somewhere in the $230,000 range. You need to use the backdoor method. So you put it in a traditional IRA and then you non-taxably convert it into a Roth. There's a number of ways to mess that up. Don't mess it up. There's plenty of blog posts about it. Just make sure you do a little bit of research before you try that yourself. And then a 529, this is the education account, obviously. There's tax-free growth here. There's no functional contribution limits other than the most that you can reasonably expect to need for your kid's education. You typically don't want to put $500,000 in it, because what if your kid gets a scholarship, and there's other challenges with that. But it is a tax advantaged account. And then once you've done that second tier, now we've used up we've grabbed all the low hanging fruit. Now we get into this third tier, which is where a lot of the magic happens and where tax intelligent investment management becomes even more important. We're talking about taxable accounts, and we're talking about making sure your cash is earning a little bit of a return. Next slide, please. Okay, expense ratios. I'm not going to spend a lot of time on this. Next slide. Other than to say, make sure they're as low as possible. If you're doing index funds and ETFs, you should pay less than 10 basis points for most, except for maybe some emerging markets and international funds. You don't always want the cheapest possible, but I have yet to see many funds with an expense ratio in excess of 1% that I think is worth it. So you want to mind your expense ratios. With employer plans, sometimes you're limited. You just got to take what's on the menu. But typically, acknowledging and reducing expenses to the extent possible is accretive to the investor wealth building journey. Next slide. Okay, diversification, time horizon, and asset allocation. I'm going to throw all these together. Next slide. It's an important relationship to observe. The longer the time horizon, the less the risk of losing money. So the more into the future you expect to need your pot of money, the more aggressive you can be in the short term. If I need money in 1 year, there's a reasonable expectation that I might have of having the equity part cut in half. From 2007 to the beginning of 2009, the S&P 500 was down 55%. But in spite of that, once we stretch out to 5, 10, and 20 years, there's never been a 20-year period where the S&P did less than 4% annualized. Now, that's the very, very worst. There have been times where it's been 18% annualized, which is kind of crazy, 18% per year. So it's important to acknowledge this relationship. If you have a short-term need, you need a very conservative investment. High-yield savings, treasuries, CDs. As your needs are longer into the future for financial independence, for something for 20 years from now, then you can take more risk. You can be more stock market oriented, stock centric. You can have less bonds and more stocks, and that will allow you to build wealth effectively over the long term. Next slide. A quick note on some other special tools. Separately managed accounts. This is for the taxable investing. It's helpful to tax loss harvest. So when you're using that brokerage account, you want to make sure that whenever stuff goes down, you can sell it, realize the loss, and offset some of your income. Because you don't have, especially if you're W-2 only, you don't have a lot of other opportunities to do that, to have some tax benefit. So the taxable account is where a lot of that's going to happen. Using a separately managed account or a direct indexing strategy is a great way to get at least a little bit of tax benefit from those investments. For the sake of time, I'm going to fast forward through the rest of these. Next slide. Yeah, and then figuring out when do you have enough to be able to punch out of work full time or begin to taper your FTE meaningfully. It's an opportunity. It's another good place, sort of on the back half of goals, communicating with your spouse, reflecting on what your values are, and thinking about when is it time to take the foot off the gas. That's an important conversation to have. Next slide. This is my contact info. I welcome any emails from anybody who has any specific questions. If you want to speak about a specific question that you have, there's the QR code for that. I created an ebook that's designed for paying docs who are just building their career. So highly recommend that resource if you're looking for some additional enrichment material. Thank you very much for having me this evening.
Hello, my name is Jackie Weisbein, and I just wanted to say that if you don't know who I am, I practice in Napa, California. I neglected to make a pretty slide with all this, but I'm happy to give you all my contact info. I am not a certified financial planner, but my dad is a tax attorney, and so you'd think that would mean that I would have done a really good job of listening to someone like Justin, but instead I have horses and very expensive habits. So if you are young in your career, you should absolutely get in touch with Justin. And you can likely do a lot better than I did. But what we are going to talk about today is insurance. And what we want to talk about is like protecting your investment. You should think of yourself as a luxury. And I know that was like a Taylor Swift thing recently, but when I say a luxury, like you put a lot of time into your education, right? And that's your ability to earn. So when you think about insurance, it's not just an obligation, but also like a cornerstone of your financial resilience. It's not just planning for disaster. It's really also ensuring that if something unexpected happens, that you don't have a derailment of everything that you've worked for. So what actually protects your income? There's a couple different things. One is disability insurance, so to replace your paycheck if you, God forbid, can't work. Malpractice insurance protects you from legal and financial consequences tied to patient care specifically. Then we have umbrella insurance, which is specifically for protecting yourself, auto and home, and then life insurance, which can safeguard you, and those rather that rely on your income if you're no longer there. Next slide. So when you think about disability insurance, this is kind of like your safety net. It's arguably the most critical insurance that you'll ever buy. And if you haven't done it yet, you should absolutely, while you're in training, start looking into this. I will tell you one thing. When I was in my residency, I was engaged and then I was no longer engaged. And I went to a psychologist and I was like stressed in residency. And later that psychologist had documented that like I was a binge drinker and all this stuff, which I wasn't. I was, but whatever. This is what they wrote. And when I applied for disability insurance, I got rated as being depressed. And so this affected my ability to get insurance. So I'm not telling you that you shouldn't get psychological care if you need it. I'm just saying that like be aware that sometimes people that are treating you can document things inadequately. You want disability insurance, and the most important thing is own occupation. So if you're an interventionalist, let's say you're a physiatrist, you could do general rehab, but you might not be able to do procedures. Having own occupation is really important because that means that if you, God forbid, were like unable to perform a procedure, but you could still do general rehab, you could still collect your disability insurance, assuming that own occupation is there. The benefit's typically about 60 to 70% of your take home pay, and there's usually a 90-day elimination period before that begins. So, this typically lasts till about the time you're 65 to 67. So, if you're already 50, it's probably not a good idea for you to be like, I should get disability insurance. But this is something that you should really be thinking about now, and it's something that is yours, and you can consider an individual policy, and there's a number of companies that can offer that, and I'm happy to talk about that with you offline. Next slide. When we talk about malpractice, next slide. Okay, great. When we talk about malpractice, we're talking about the insurance designed to protect you from one of the biggest financial threats in your practicing medicine, which is litigation, right? So there are two types. One is occurrence. Occurrence covers incidents that occur during the policy period, even if the claims are filed later. There's also claims made, which can cover claims filed during insurance periods, but like let's say you're leaving a job. So a lot of times people ask like, do I need tail insurance or do I need nose insurance? So for example, when I left my last practice, we were using, I think, the doctor's company, which is located here in Napa. It turns out that my current practice offers that as well. So I didn't have to ask for tail coverage, which is basically at the end of your practice. But I asked for nose coverage, which was basically covering me retroactively now in my new practice with the same thing. So things to consider as you're leaving or starting a new practice. You're going to want to change things proactively to clarify who's going to pay for that. So when you're talking to your job or, looking at a new job, you might want to ask, like, is tail insurance something that you cover or do I have to cover it? And who is actually the insured? Is it the practice? Is it you as the doctor? Review your consent to settle clause. That means like if you have to settle because the insurance company is demanding it, what does that mean for you from a licensure standpoint and your ability to practice? And then also, you want to make sure that everything you do is covered by your malpractice. So if you decide that you want to start doing minimally invasive spinal fusions and you don't know if your malpractice insurance covers that, the first person that you should be reaching out to is your malpractice carrier to ensure that the things that you want to do are covered on that. Next slide. So when we talk about other insurances, one of the things that people don't realize is that you can get a lot of insurances for your home, right? So you can get home insurance, you can get renter's insurance, but when we live in a state like California or other states, things that you have to be aware of is that, are you liable if somebody comes after you, right? So a lot of times people are like, okay, I'm going to sue my doctor because I think my doctor has a lot of money, or I'm going to go to my friend's house who's a doctor and I slip and fell and I'm going to sue my friend who's a doctor because I know that they have a lot of money. Now, you don't think this may happen, but trust me, the reason my dad's a tax lawyer is because his oldest brother stole $30 million from our family business. And so the truth of the matter is you never know who's going to be the one that screws you. And so when I say this, you want to make sure that you have a low cost but powerful safety net that can fill gaps in your both homeowners and auto policies. And because of the fact that you're a high earner, it's wise for you to cover about 1 to 5 million in umbrella coverage. This kind of increases whatever underlying auto or home limits you have, and also can add uninsured or uninsured motorist coverage to your regular insurance for your automotive stuff. But if you rent, also renter's insurance for liability as well as personal property. These are really important things because, again, we live in a litigious society. And so sometimes people are going to come after you. And this kind of is one additional way that you can protect your assets. Next slide. So when we talk about life insurance, there's a couple different things. I think a lot of times we get told, you need life insurance. The truth is that the people that need life insurance are the people that are relying on your income, right? And what I mean by that is that they want you to have life insurance. So if God forbid that something happens to you, they're taken care of as well. When it comes to life insurance, one of the things we have to be real aware of is that there are a number of different types. Now, there's term life insurance, and then that's usually something that a lot of young attendings like to go forward with because it's affordable and pretty straightforward and designed to cover your highest financial responsibilities. You can adjust coverage amounts, the time, 20 to 30 years is typically common. Is it portable? Can you take it with you if you move, employers? And it can also be updating with the beneficiary. Sorry, that's my dog. And your spouse, depending on if anything changes with that. Now, there are some controversies in this next slide. When we talk about controversies in insurance, one of the things we want to talk about is term versus whole life. Whole life is heavily marketed as a wealth building tool, but it's actually not really great for most early career physicians. The reason why it's an expensive solution. What it's doing is combining insurance and investment as a vehicle, but the returns are often inferior compared to some of the basic investing that Justin went through. There's high commissions that are incentivized overselling of this product to a lot of physicians. So if someone's trying to sell you whole life insurance, just be careful on that. When you talk about your disability insurance, own occupation versus any occupation, so some policies only pay you if you can't work in any job and not just your specialty. So it really is important that you verify that you are getting own occupation. If you think that just because your employer is giving you a disability policy or a life insurance policy, that's going to be enough, it may not be. And the reality is that sometimes they're just getting a cheap policy for everyone. And so your medical assistant may have the same policy as you. In our practice, the 6 partners, we all have a $2 million policy of a life insurance policy that a practice pays for and bought for each partner. Why is it? Well, if something happens to that partner, 1 million goes to the family and 1 million goes to the practice to cover the expenses and things like that would not be covered by that living partner who's no longer there. So there's ways to protect yourself in your business. And then there's also some buy-sell and key person policies. And a lot of practices have buy-sell agreements and key person policies that are poorly structured and oftentimes misvalued, or they are owned by the wrong entity, which can lead to some tax inefficiencies and conflicts regarding like partnership and things like that. So having someone that's a certified financial planner like Justin help you navigate that is really important. Also, index life or infinite banking schemes, they're complex. They can be high fees with phrases like tax-free retirement. It's really careful to have somebody explain this to you clearly. But if you don't have someone explain it to you clearly to make sense, don't buy it. Again, when we come to the consent to settle tail coverage, again, sometimes it allows your insurer to settle without your consent, and that can damage your record and affect your medical board standing in the state. So it's really important that you recognize that because it can also leave you open to massive tail costs if you change jobs depending on it. So make sure that you negotiate these charges or clauses rather when you're clarifying your coverage for that. And then also there's always going to be some type of commission incentive from some of these people selling it. So again, be cautious and have someone that can really help handhold you through this. Next slide. So common mistakes, the most frequent errors that typically physicians do are relying solely on their employer coverage or choosing weak disability definitions or forgetting tail coverage or letting policies lapse or not actually doing it early enough in their career. So if you can follow these kind of couple things in a checklist. One, price and purchase your individual own occupation disability before you start your first job or early in your career. The next is confirm your malpractice type and the limits and your tail responsibility in writing. Add about $1 to $5 million in umbrella coverage so that you can protect yourself. And then buy a level term life policy match with your financial obligations so that you can ensure that you are protecting your family. Insurance really isn't about expecting the worst. It's about ensuring the unexpected doesn't erase everything that you've already built. So set aside 30 minutes this month and review your policies or get into it or find an insurance person. Like my dad is a tax lawyer that also sells insurance, so I do all that through him. But the truth is that I'm not marketing for my dad. I'm just telling you that if you don't have a good person, you need to find one, because understanding how to like protect your money that you've just spent all this time building is a really important thing. Next slide. So again, price it out. We've got this action list, and I think I already reviewed this. Sorry, I got really excited. Next slide. So that's all I have, and I'm going to pass it on. I think David and Alan have some things to share here. So thank you guys all for joining, and I'll pass it on to David and Alan.
Yeah, thank you, Dr. Weisbein. Amazing. For the sake of time, we won't take very long because we're going to have a Q&A session right after our part here. I'm going to ask Dr. Alan Lin to just really briefly introduce himself. He's the co-chair of the PSPS Leadership Immersion Track.
All right, so I'm seeing actually a lot of the new friends, old friends here, and I really appreciate it. Actually, Dr. David Lee and me operating this LEAP program. Really, actually, we got now pretty big number of alumni. And then each year, we are banking our head because there are a huge number of applicants, and really impossible for us to kind of find a candidate to be shortlisted and invest the resources. These are all kind of difficult decisions. And for myself, I practice in mostly in Sacramento and Bay Area. And so I just closed my private practice because I realized the insurance market is kind of going to fail, and no matter how hard work, it's not going to kind of make it sustainable. But on the other hand, other exploration was more successful, and Jackie and me met each other in London, and I have been helping Team GB since London Olympics, and we got a good job in Paris. Now getting actually more job done, hopefully in LA. And MMA, UFC, I'm the medical consultant for the UFC PI, and I work for ATP and PGA. I'm sure there are many golfers. I'm in the board of a golf tournaments series in the North California. So I think, of course, when I was in business school, and money talk everywhere, right, in UC Davis, and people are surprised, oh, we are a doctor here, because truly we don't have the money wisdom. I think I enjoyed the listening for those speakers in the panel, and then also Hajat actually brought this idea in the education committee, and pretty much all the doctors raised their hands. Wow, such a good idea. So I wish I could have this opportunity to kind of get some right decision in the early stage of the career. And so I will leave the rest part to Dr. Lee, because he truly actually got the mission and set it up pretty much all by himself. And I'm trying to steal his foundation, and think we are both Dr. Lee and me are trying to help as much as possible.
Yeah, thanks, Dr. Lin. That's very kind words. Again, I want to thank the panelists. It's amazing the amount of knowledge, and I think we sometimes take for granted a lot of this information that they're presenting. Dr. Weisbein has been on some of our monthly calls. So really quickly, LIT is an initiative that was designed to really develop the next generation of leaders in the pain and spine space. PSPS is great, and we have great founders and people like Dr. Weisbein, who started the organization and have kind of seen it grow over the past 6 years since its inception. But without future leaders, a society can't continue to be sustained and to go on. And so we really need to nurture that. And so it's really focused not just simply on clinical training, but looking at things like leadership, business strategy, for instance, tonight, healthcare innovation and collaboration between spine surgeons as well as interventional spine doctors. Each month, we have a monthly meeting. Members get together virtually. We learn on expert topics like contract negotiation, practice setup, clinical research, academic practice. These are just one of a few. Participants are also integrated into PSPS committees, social media, educational projects, as well as publication experience, with the eventual goal that when lit members then graduate, they go on to take more leadership roles within our society. We are very, very, very proud to welcome our newest class of lit members. We have now 21 lit members total, and we're very much fortunate to have them, and we really are looking forward to this upcoming year. I want to thank our panel members again, and then I'll turn things over back to Dr. Bandal to Q&A.
All right, perfect. Thanks, David. Yeah, it's a great program. I actually went through it as well. So if you guys are, interested in meeting people with similar interests and just meeting people doing pain management throughout the West Coast and the country, great program to become a part of, and helps you really build your leadership skills and move forward in different societies. But yeah, I want to thank you to the panelists. This was great. I definitely learned a lot as well. I know these guys are a wealth of knowledge, and their contact information is always readily available. So if you want to reach out to them, I'm sure they will not mind. And then Justin's great. I worked with him in the past as well. I think him having a physician spouse really gives him an edge and a different perspective over a lot of the other financial planners. So I know that was a lot of information really quickly. This will be recorded so you guys can look back and reference it. But we do have time for questions. I know Dr. Russo had to leave, but we will do our best to answer any questions if you guys have any. And then, as I mentioned, this was kind of part one. Even this was a lot of information, really dense, but we didn't want to spend like 3 hours covering this, so we try to shorten it. But there is an episode 2 coming up next month, which will focus more on the job search and different career pathways. So make sure you guys sign up for that if you're interested. And I don't see any questions in the little box right now, so maybe everyone already is very wealthy and very well established and doesn't need any additional information. But yeah, if you guys don't have any questions right now, that's perfectly okay. We'll give you the rest of your evening. Oh, actually, we got one question. This one is to Justin. Why is a 401k considered tier 1 compared to a Roth IRA?
Good question. I'd say in the context of our discussion, I wouldn't focus as much on the 1 versus 2, because hopefully you're going to fill up all of them if you're an attending. It's on the top in this context because for a high income person, you're getting a tax deduction in the current year, so it's reducing your tax burden in the current year, where a Roth IRA, while tax advantaged, doesn't reduce your tax burden.
Yeah, perfect. And then obviously a lot of these questions are very nuanced. Everyone's financial situation is always different. So that's why I think it's really good to reach out to someone. And especially with student loans, I still have student loans that I'm sitting on because you don't know what the government's doing. And I had a meeting with someone, and it's just a crazy world right now. So definitely, seek out some help, because having some professional advice there, just a small meeting can save you, thousands of dollars.
I mean, just to say one thing there, like when I went through training or school, whatever, it was a long time ago now, it was like 20 years ago. I still had some student loans. I think I had like 280, and I think I have like 30K left, but they're all like still 2.5%. So it's like I'd rather put my money into interest-bearing accounts that are going to make more and pay those other ones off slowly, but still aggressively. So having someone like Justin who is knowledgeable that can help you eke that out. My boyfriend is a little younger than me, and so he had like 250 grand in loans, but he had like 6, 7, 8%, and so he was like, I'm going to pay all these off right now. And I was like, great. Like, I've already paid down a whole bunch of loans. So, having someone explain this, but if you guys have any questions, please don't hesitate to reach out to anyone. David gave me a lot of hype. David and I did residency together like that long ago in New York, and I'm just so honored to be a part of Lit and get to be a part of this. So if you ever have any questions or you want to know like which doctor disability companies to explore, happy to tell you about the ones that I've had good luck with and the ones that I've had bad luck with. And I again want to really reassure people you should still go to your psychologist if you need help. Just, you know, sometimes if you're paying with your insurance, all those things are going to be disclosed. So like even if you took like Ambien during your residency because you were on like a night shift, all that stuff gets released to your insurance company. So just be really aware of what you're doing, especially young in your career, because most of us aren't thinking about it when we're going through our training in our early career, and it really can affect us. And I found out the hard way. So learn from you know, my mistakes. And thank you for having me so much, Harjo. I appreciate it, and everyone on the Lit team. I appreciate it. Alan. It's always nice seeing you. I see you in person on Tuesday and now today. And thank you so much for having me.
Yeah, perfect. Thank you guys. I don't see any other questions, so we'll let you guys go and we'll join you for the next one. Thank you guys.